Hey guys, super happy and pleased to be here once again. And today I'm super surprised and happy to have you here, Peter, on our show, the Trade Pod. As of always, we like to combine uh, conversations from all around, from people that does everything that's heavily related to the financial world um, and you, Peter, you bring a slightly better approach about everything that really takes business um, among M&As and risk and everything that people really never talk about, which for me at least, it really pumps me. So it's a pleasure to have you here on our show, the Trade Pod. Super happy to have you here after so many times we tried. Um, yeah. So say hello to the listeners.
No, hi everyone. Hi, Fekant, and thanks a lot for having me. It's really an honor and a pleasure to be here. And I think that I really not enough people talk about M&A. And you know what? I think some people do, but they're not heard enough. So maybe that's a good opportunity to kind of expand our horizons today. So
People talk about Eminem, the small chocolate. You know what I'm talking about? Yeah, you know.
they do, they do.
Especially when they're inside the McDonald's McFlurry. Disclaimer: this is not a promotion or something. So, Peter, with that, before we dive deep, let everybody to know who you are.
Well, I'll make this short, but I've been in the M&A world for quite some time now. By profession, I'm a lawyer, an Israeli lawyer, actually. I graduated from law school, Tel Aviv University, and I'm an Israeli lawyer. I worked in and around M&A and private equity for the very, well, I would say for the better part of my career. I was working in some of the top law firms in Tel Aviv, doing a lot of cross-border M&A, as well as local M&A, but the majority was, I think, cross-border M&A throughout my career. I also did quite a lot of corporate finance, which is interesting, and a lot of financial regulation. So I think in that sense, it gives me some kind of maybe interesting perspective to look at things. Um, I was doing that for some time. So in my last position there, I was a partner of one of the big law firms in Tel Aviv. And then I actually moved to Marsh. And for your listeners who are maybe surprisingly don't know who Marsh is, so Marsh is the largest insurance broker in the world. Our parent company, Marsh McLennan, is traded in New York. It's a publicly traded company. It's a Fortune 200 company. We have, the number is vast. We have 85,000 employees across the globe. It's you say that number, but you actually don't grasp how big this organization is. Um, and yeah, and Marsh is by far the largest insurance broker in the world. And I came to the Israeli team, and I joined the Israeli team a couple of years ago to set up locally their private equity and M&A practice in Israel, which deals with our risk management and insurance solutions for private equity and M&A. And we've been doing this on the ground quite successfully over that period of time. And as of 2 months ago, I now also, on top of leading our M&A practice, I also lead what we call the entire special risk practice of Marsh and Israel, which includes also our cyber practice and other special risks, which are directors and officers, risks and insurance, professional liability, and the like. So these are the three teams that I currently lead in Tel Aviv. And in Israel, I work a lot on cross-border stuff together with my European US teams. So I think we get a very interesting perspective on how things look like, both in and out M&A, private equity, and also from other angles with corporate clients, and how they manage their risks currently, not only, by the way, on the M&A side, but also on the cyber side and on the directors and officers side. So that's, I don't know if that was short enough, but that was shortly me.
Every time when I hear about somebody's background, I really get inspired by how things led to other things. And I would like to ask you, what led you from being a lawyer onto M&A? Because M&A is really is a really tough field. It's similarly equivalent to battlefield, and when you're part of a well-established law firm, jumping on M&A is a really is a slightly pivot, which I would love to ask you about how you gather the courage to move on.
It's a good question, and I've been asked this quite a lot actually. It's interesting because the M&A insurance world is something that is around for around 25 years. In insurance terms, that's a very short period of time. When you look at the history of insurance in the UK, right? You look at Lloyd's of London, you look at the history of property and casualty insurance, which is around for what, 200 years, give or take. And then, obviously from an actuarial perspective, when you look at those areas of business, you have very long loss runs, you have the history, and obviously, we have changes over time and we have climate changes and things change, but you have a history you can rely on. And in insurance, that's very important. And when you look at this area of business, which is only around for give or take 25 years, in insurance perspectives, that's actually a very short period of time. But that realm of insurance really changed how we look at M&A, and maybe we can delve into that in a second. But I think that was what was very intriguing for me. So what we started to see a few years back, and I think we started to see it more vigorously in the US about 10, 15 years ago, in Europe over the last 7, 8, 10 years, and then obviously in Israel as well over the past 3, 4 years, we started to see those products being much more prominent and changing the way people actually do M&A. And I think for an M&A person who's has done a very big chunk of his career doing M&A, I think that was very intriguing to see how there is a shift and how that tool comes into play much more in M&A deals, and actually change in a way, in many ways it's changing the way people are doing deals and how they're looking at deals, because it's really changing the process from start to finish. So I think
Mhm.
that was very intriguing to take on that challenge at Marsh. And I think, going to Marsh, who is, Marsh is the largest M&A insurance broker in the world by far, right? So it's not a startup. It's not going to an organization where you have to build it from scratch. Obviously, you come into a team that is hundreds of people strong, by far places most premium and does most deals on the market from an insurance perspective by a very, very significant margin from number two. So it's a very, very strong team. It's a great team to kind of get integrated into, and start their operations locally from that perspective, in Israel. And obviously, we have a very large Marsh office here as well. So we're almost 80 people now. We're growing rapidly in Israel, also on the ground. So it's not like you're alone in that sense. But yeah, I agree with you. It's a jump, because doing that legally or doing it from an insurance perspective, there is a difference. There's obviously a difference in the way you look at this, and in your day to day, and how do you engage about this in your responsibilities, in your role in an M&A transaction. It's completely different. But I think I found obviously certain similarities. You still rely on what you're bringing from your previous position, from the knowledge you have on M&A, from how you handle deals. So I kind of I thought that that portion of taking what you already know and then adding new elements into that, which is quite significant. I thought that was an interesting challenge, but it's definitely a jump. It's a decision you take, and you kind of decide to go on a bit of a different challenge and to take on that challenge. I thought it was very interesting. Like every challenge, you have your advantages, your disadvantages, but so far it's been a great ride.
Mhm. I asked you about the jump that you made from being a part of from a part of a law firm onto M&As. Now, I would like to ask you right now, on your current role, you're head of special risk in Israel, and out of your perspective right now on the world of risks, how would you judge yourself as an M&A in private equity broker, in a much proper way? Because M&A is, I think, one of the strongest tools that, if your intention is like to transform your business overnight, you should do a certain type of acquisition, or merge certain activity of your business onto another business, which um, might might expand your business or might downgrade most of the operations that you're taking a part of. And my question, to summarize everything that I just said, is how you would hedge yourself out of any possible risk that might come onto the journey. And finally, how would you fulfill the entire needs for the client um, to make a proper acquisition process?
Definitely. I think that's probably the number one question people ask themselves, right? When they go into an inorganic
I'm not that
growth.
clever, so I'm not that clever. You
No,
say
no,
that I'm not
no.
that clever.
You know what?
I'm
That's
insulted right now. Thank you.
I think I think it's definitely the number one question. But you know what? You'll be surprised how many people do not stop during that journey and think about that question. Because supposedly, you say, right, it's the number one question, but a lot of people go into inorganic growth paths without actually stopping for a second and thinking about the ramifications of that decision. Because as you said, and I completely agree with what you said, we have seen companies over time, both on the private equity side, but especially I think on the corporate side, when corporate buyers are looking for something that's synergetic to their business or looking to expand in a way, and they're rushing themselves a little bit into inorganic growth paths, sometimes it could end with real damage to the buyer. Because when you buy something that you don't need, or you do not think through how you're going to integrate that organization, and on so many levels, when we talk about M&A integration, it's so difficult on so many levels in terms of culture, of business culture. Do I have the right people? Is this what I need? Can I give them the same environment that they have now, assuming it's a successful organization? And it's a very, very, very difficult path, and a lot of people do not think about it.
How
So
would you calculate all those categories? Because by the end of the day, you as a service provider, you take the job and at the end of the process, you fulfill the job that you're supposed to do. But eventually, the business wasn't ready, wasn't there yet. So how would you calculate it? How would you think about every aspect that they just said in order to build a much more um, to make a much better fundamentals onto the continuous parts of the process.
yeah, so no, definitely, and I think we have various tools we use or various services we can provide our clients to actually mitigate that and to give them that comfort. For example, let me give you one example. So
Hmm.
one of the main things we do, and I think one of the main products we work on clients with is what we call and what you probably know as reps and warranties insurance. So reps and warranties insurance is a product whereby usually the buyer buys the insurance. They're the named insured on those policies, and it protects the buyer against breaches of representations in the acquisition agreement by the sellers. So essentially, you get a bunch of representations in any sale agreement, no matter if you do it in the U.S., in Europe, in Israel, doesn't matter where you do it. Sometimes it's dozens of pages long. Would that give you, or supposed to give you, a representation of the business you're buying, right? The financial situation, the tax situation, employees, litigation, everything around the business. And sometimes you close the deal and then you find out that there were some inaccuracies in those reps or some things were not exactly how they were purported to be. So that's the number one
Obviously,
problem. And that's where reps and warranties insurance comes into play, where that gives you the ability to claim against insuring again, and not go after the seller or starts looking for the seller, going after them in court, and dealing with this for a very long time. It's a very, very efficient product that gives you a very, very clear path to against whom you should claim, which is usually a very reputable insurer because we only work with reputable insurers in the US or in Europe, it doesn't matter. It really simplifies the M&A process as well, because that's a side effect of that. Because once you have that, then the entire negotiation around the reps is easier. Everybody feels much more comfortable giving those reps. Obviously, the reps have to be true. That's a given. But it's much more easier to negotiate. Obviously, the sellers have a very big benefit because they get all the money when the deal comes through. If there's a problem, the buyer goes to the insurer, so that's very convenient. And as I said, the buyer has very significant advantages as, for example, going through reputable insurance instead of chasing a seller that they don't know, getting a very wide set of representations instead of negotiating something with the seller that they're not willing to give them wide reps, long cover periods, very long cover periods, etc. So that's a very interesting risk allocation tool, and I think that was a very significant driver in our, what we call the private equity M&A practice over the last 10, 15 years across the globe. So that's one tool we can give our clients. And then we have a bunch of other complementary tools that we can give our clients from various angles. So for example, we have tools like tax liability insurance. Tax liability insurance covers you for things you actually know before you buy the companies. For example, if you're doing your diligence on the target company as the buyer, and you're already seeing that there's a tax issue, or your advisor has spotted a tax issue, potentially we can take that tax issue and insure it as well, and kind of take it out of the picture. Because then, when there's an issue, the seller says, "Come on, there's nothing there, just leave me alone. There's no need to discuss it." And the buyer says, "No, there's a real issue here." And when the parties cannot agree, that's another solution we can give them to kind of take it out off the table, solve it by insurance, and then continue and sign and close the deal. And we see that these are very important tools. Now, one tool as the tax liability insurance, it helps you kind of go through exposure you're seeing. The reps and warranties insurance covers you in case you bought something, but then you find out that not everything is exactly as you thought it is. Other tools we have are more tools, and as I mentioned in a second, and these are tools that also our sister companies offer. So, for example, Mercer, one of our sister companies, offers HR due diligence. So it helps you kind of calculate your steps forward from an HR perspective, what kind of employees you're taking, how you should compensate them. What's the benchmark in this industry? How do you make sure you actually integrate those employees into your company post-closing to make sure it's a successful integration process? So in a sense, what we give our clients is the entire package. How you enable yourself to actually close the deal and sign and close the deal and actually get what you want to get. How you protect yourself against any exposures in the acquisition agreement and following that post-closing, and then how you prepare for integration.
I have two questions. Now I'll let you to decide with what questions should I start with. A question about nowadays situation with the interest rates, or hypothetical situation, and how would you operate in this situation? I'll let you to decide what question to choose on.
I'm afraid of what you're going to ask hypothetically. So we want to start with the interest rates, and then we can go to the hypothetical situation, or
No, we'll start it by we'll start
no
with the
problem.
hypothetical
No
questions.
problem. Go ahead. Go ahead. Shoot.
Just to make it much more challenging for you.
No
Right
problem.
now, you spoke about the funnel that you're offering. That's not surprisingly you're offering to clients among M&A process. And for each and every level of the funnel, you actually have a properly prepared solution that might make the process much more easier. And now that's where the hypothetical situation comes in. If you were an entrepreneur working on a startup or a new company, how would you plan to build an all-around solution to the customer out of your perspective as one of the executives for the Israeli team here in Marsh? Like, how would you take a certain problem, and how would you tackle each level in order to make sure that you have let's call 100% solution, or in sort of like until you have
No, no,
BMS.
I
And you
completely
never
understand the
can.
question. Look, we do that a lot. What happens is that we work with our clients from their very early stage startup phase and until they hopefully grow and become a mature company and until they acquire other companies or until they're being acquired, right? So we work with them through the entire phase, especially when you look at the high tech industry. We have a lot of clients in Israel and the US from the high tech scenes where you actually see that entire journey and us accompanying them through the journey. Now, it's very important, and I completely agree with your question. It's very important to always tailor what you're doing with the client to their current situation. A small startup doesn't need huge insurance policy, doesn't need certain solutions that they, first of all, don't still have money for, and second, they at that stage they don't need it, but they do need a full suite of insurance, for example, that they need at the very beginning. For example, we're seeing a significant rise in cyber insurance. So, right, cyber insurance 10 years ago was a niche and many people don't understand what cyber insurance is for. Now you have so many more clients buying cyber insurance because eventually almost any organization, from a small startup to a very very large, Fortune 500 company, everybody's vulnerable to cyber attacks, and people are buying cyber insurance, and it's becoming so much more mainstream. And this is something that we can tailor for our smaller clients as well, and give them the simple, the excellent Marsh solutions, but for a very affordable price because that's what they need at that point of time. But when they have that, for example, they can engage with partners. Because, for example, many suppliers or clients in the US require um, their partners to have cyber insurance today. People come to us with their agreements from their partners saying, listen, somebody's asking me for cyber insurance. I don't know what it is, but I do need it because I cannot engage with them. I cannot work on a relationship before I have that. So we have those solutions very, for every company at every stage of development. So you do need that cyber insurance. You do need that basic directors and officers liability policy because your investors are probably demanding you and saying, listen, you need to take out that policy because I'm a board member now in your company. I want to know that I'm insured. So those basic policies should be there from the start. But for example, there are other policies that you really don't need at the very beginning. For example, you have what you call in the US the errors and emissions policy, the technical the tech E&O policy. Now, this is to cover any errors and omissions in your product. But sometimes when you still don't have a product, you don't need an E&O policy because you're not selling anything and you don't have any pilots with any clients, you have nothing. And we're seeing some clients coming to us and saying, listen, I have an E&O policy, and they really don't need it because they're at such an early stage where you don't need it, and it's money that you better spend on R&D probably. But then as you develop, it's very important to keep track of what you're doing and to make sure you have the correct cover. So when you have a product, you need an E&O policy now. When you have a product, you probably need a higher limit for the your other policies because your risk is growing. You're working with more partners. You have clients now. It's a very different risk now we're facing. And then when you're growing and you're saying, listen, now I'm looking at acquiring companies, then you're looking at reps and warranty insurance because you're saying, if there are any mistakes here, if somebody's misrepresenting to me, I want to know that I'm insured and I want to know that I'm going to get, compensate for my damages. So it very much depends on where you are, and very much depends on whether you need a long-lasting policy that renews every year, or you need a one-time policy like a reps and warranties policy, which is a one-time policy you buy for each acquisition. So that changes very much, and our specialty is to kind of adapt and adjust to each stage. So when you look at an entrepreneur, like you mentioned, at the very beginning of their way, the correct thing to do would be to see what actually they need, but to minimize that probably at the very beginning, to not overburden them and to allow them to focus on what they need to focus on their day to day. When they develop, then obviously we need to adjust accordingly to make sure that we keep them protected all the time.
I knew it. I knew that I was asking the right question. I knew that I was asking the question that I should have asked a long time before the right man. Um, so, um, by the way, noted. I will take it and I will use your hypothesis in a much more further steps that I'll take on my career. Now, I would ask you the other question that I would like to ask. Nowadays, 2024, 2025, I doubt how much acquisition would appear on your board in the future, in the near future. And I would like to ask you, how do you feel the business of M&A over the past year, and what do you think would be the future of this business in these upcoming years since we're taking a shot in January 14th, 2025. Um, Let me know.
I may
Let me know
surprise you.
what do you expect?
I may surprise you because I think I'm going to be more optimistic than you. Look, it's interesting. If you go back,
I come from the financial markets. You are the one who actually gets the acquisitions on your table. And if you're optimistic, I must be way more optimistic than I am right now. Now my
that's probably
tale,
true.
and I'm gonna tell my colleagues, what do you think? They will
Look,
pay
I
me.
think we should take a look back 4 years. We should take a look back 4 years ago. 2021 was a crazy year. It was a crazy year. Interest rates were minimal. Money was everywhere. People were doing deals left and right. I think everybody was overflowed with work. It was when we're starting to come out of COVID, still in the middle of COVID, right? But still starting somewhat to come out of COVID, if we kind of call it the endpoint of 2022. And the market was insane. And the amount of M&A was crazy everywhere. And that optimism was coming into 2022, which was, I would say, at least in the first half, or you know what, for the most of that year was a good year as well. And then came 2023. And on the back of 2022, when Russia invaded Ukraine and we started seeing those geopolitical tensions in the beginning of that year, notwithstanding, kind of, I think carried by the tailwinds that we had from 2021, 2022 was still a good year globally. And then 23, you started to see a decline. You started to see issues globally because you started to see, all the macroeconomic effects, and you started to see inflation rates going up, and you started to see interest rates coming up as well, and you start to see the sharp decline in M&A. I think that happened in 2023. It came also into 2024. I think in the beginning of 24, everybody was very optimistic, saying, "Listen, 23 was a bad year. 24 is going to be a better year." I don't think globally we have seen that everywhere. It depends where. So, for example, in the US, we saw a better year in 24, a much better year in 24 than in 23. Again, not a record year, but a much, much better year. Elsewhere, it was not such a good year because interest rates were still high, because the inflation rates were still high. Now, actually coming into 25 and looking at this for a second globally, we're actually fairly optimistic because what we've seen in the last 2 years, we've seen the private equity industry accumulating or having from 21 to 22 huge amounts of what you would call dry powder of a lot of money that wasn't deployed in the last 2 years or was relatively scarcely deployed if you look in comparison to the previous years. And those private equity funds, all the big players, and not only the big players, also smaller players, have a lot of money to spend on M&A right now. And that money needs to go. That money needs to be utilized, and they have to go to market. And I think we're starting to see that trend through the second half of 24 and coming into 25. Now that interest rates are coming down a little bit as well, so financing of deals is becoming, again, more viable than it used to be a year ago or a year and a half ago, where financing of deals was, for many players, off the table because it was too expensive. So you couldn't really leverage, you couldn't go for aggressive LBOs, go for leverage buyouts because the money was too expensive. And when money is now starting to take the correct direction, we're starting to see the market waking up in that sense. With the dry powder that private equities have, we're thinking, 25, this should be a very, very good year. Again, looking globally. If you look at specific places, then again, it's not always the same everywhere, right? We still have geopolitical tensions. You look at Russia and Ukraine, Israel, the same in that region. So that's also a different issue. So that's also a bit of a different issue. But if you look globally, you are seeing a lot of potential. Now, there's another element on the other side. 2021 was a year where valuations were insane, especially when you look at the tech industry. That was quite crazy. And buyers were willing to pay for that. So buyers were willing to pay quite crazy valuations. When you look 3 years, 4 years later, it's a very different market. What happened over that course of time is that when we had, again, inflation going up, interest rates going up, buyers were starting to say, look, I'm not going to pay you 100x, I'm going to pay you 25x or 50x. And sellers, a lot of founders, a lot of entrepreneurs, as you mentioned, were saying, no. 2 years ago or a year ago, I would have gotten 100x. I still want my 100x. And that gap between sellers and buyers was in the market for a very, very long time. And it was quite clear it will take some time for sellers to understand that they need to adjust. The market has changed. And it takes a lot of time for people to understand that I cannot sell my company for 100x anymore. I probably need to sell it for 50. But sometimes by the
Do
time
you
they realize that,
recognize do you recognize the liquidation for this gap nowadays?
do I recognize, again, sorry?
A little bit of liquidation. That this gap might get closed in the near
Yes.
future.
Unfortunately, I think the answer is yes. I think we're seeing in the market more cases than what we used to see in the last couple of years, especially in the tech industry, of companies running out of runway, companies that don't have more money to spend. And unfortunately, that leads them to to liquidate or to close, or to be sold off for a very, very low price, because they have reached a situation where they don't have a choice. So the answer is yes. I think that that gap kind of led people to a position sometimes where they don't have a really good choice, or being sold for a very lower price. So in that situation, with a lot of money in the market on the one side, on the other side, especially in the tech industry, you see much lower valuations, or much more reasonable valuations, which gives great opportunities in the market for certain players, also for the private equities, but also for the large corporates. You saw that, for example, over the last year in the cyberspace, which is quite crazy. You saw the consolidation in the cyberspace, the large US corporates, the large players coming in and swooping more technologies and adding more technologies into their toolbox, because they're seeing great opportunities for lower valuations. So I think that combination, if we go take a step back from this, you see that combination we think is going to fuel a very, very active 2025.
Understood. Now, let's put aside a little bit the world of M&As, and I would like to ask you about your current role, which is special risks. Um, to me, I don't think that I understand this world much as I understand the world of M&As, which I get my intention because I'm in the financial markets, but you know, for me, head of special risks, um it's like a shadow, and I would like to uncover a little bit more of this shadow, and let's talk about your current role and what's the surprises that you get on every day and the anomalies and everything that comes to your desk. And I would like to dive deep into this a little bit more than we spoke on the beginning of the episode.
So look, the special risks world in insurance is a very interesting world. So the special risks basically is all the risks that are not the what you would say the regular insurance, property and casualty risks. So these are all the special risks. So aside from M&A, which we've just spoken, I think you can kind of divide that category into two. One is the cyber risks, and one or many other special risks, which we'll touch upon in a second. But cyber risks are very interesting because cyber risks have become, look, the world has changed, right? In the last, I don't, I wanted to say 20 years, but actually, if you can look 5 years back, the world has changed dramatically. And cyber risks have become something that is so prominent and so significant for so many clients that this is something we're dealing with every day. Because what happens, what's a cyber insurance policy? It's a policy that pays you for damages that happen to you because of a cyber event at your organization, right? So you have a hacker, hacking into your system, blocking your system. You cannot access your system, right? It's huge damage for many organizations, and it happens much more often than you think. And we deal with those events, with those what we call cyber incidents, on a daily basis because we have a lot of clients. There are a lot of cyber incidents, and we need to help them handle those. So this is a very, very interesting world because these are very, very effective policies. These are what you call active policies. The insurer engages in trying to finish that event, that incident as quickly as possible because their interest is that it doesn't cause you any damage, right? It also pays for your advisors. There is an event coordinator, there is a legal advisor, there is a PR advisor who helps you deal with what's going on in your organization. And you want to eradicate that event as quickly as possible with the minimal damage. So it's not just a policy that says, okay, a damage has happened, now pay me. It's a policy that is active in many ways. It helps you eradicate the damage and then pays you for the damage that has happened to you. And these are very, very interesting policies that obviously 20 years ago, nobody even thought that they're needed because, who spoke about cyber? And today, this is very interesting. And this forms a very significant chunk of our day to day because we, first of all, get those really good policies for our clients on a daily basis, but also we help our clients on a daily basis to handle cyber incidents in their organizations. So that's a very, very interesting thing we're doing. The other thing we do under special risks is actually cover directors and officers, which is, it always sounds a little boring because you say, every organization has directors and officers insurance, and everybody has to have that. But this is something that comes into play very dramatically with publicly traded companies. Publicly traded companies are always more susceptible to suits and to claims against their board members, against their senior management, and then we kind of use all of our fantastic toolbox at Marsh to help our clients deal with those and to get paid and to get paid if and when claims are they're due to pay any funds for claims filed against the company and against the board members and the senior management. So this is also a very interesting thing we do. And I think it becomes very interesting when you deal with publicly traded companies because they're, obviously the risk is much higher and it's much more significant. And then, of course, we have a bunch load of other policies. I can go on for hours now, but I'll stop here. But we do have very, very interesting things we do, and that we work a lot more in the crypto space these days. Definitely, Marsh is by far
Very
has
challenging.
very, very
Very
challenging.
challenging, sir.
Very challenging. And 10 years ago, if you would have asked for insurance in the crypto space, everybody used to laugh because they used to say, it's an unregulated space, nobody wants to insure it. 10 years post that, it's a very different space. Now, we won't say that everything's insurable and it's not the normal insurance world, but we're seeing a lot more ability to insure in the crypto space. So for example, today, we can insure cold wallets quite significantly with very high sums. We can insure very significant risks in that space, things that we can do in the past for a very simple reason. First of all, that space is becoming much more regulated. We saw the recent EU regulation. We're seeing the regulation also in the US. So I think that's one reason. Second reason is that you're seeing more and more big financial investors, big financial institutions coming into that space. But one of their requirements, both regulatorily, but not only, also internally, is to be insured. Otherwise, they won't go into that space. And you're seeing the big US players, for example, coming in, offering crypto services to their clients, investing in crypto, buying Bitcoins, etc. Everything is insured now because obviously if it's not insured, those players won't be there. So we're seeing the market taking a shift. It's a slow shift. It takes time, but we're definitely a market leader on that front as well. And we have quite a lot of market leading products in that space as well, and unique access to insurers who can actually insure you in that space as well. So this is also something that we do in that space. So I think the special risk world is super, super interesting, and it's much more diverse than what people usually think.
Out of the depthness of the cryptocurrency world, I would like to ask you, like, Marsh is like a massive corporation, but I would like to ask you if you, as an executive, would come up with an idea to ensure a certain operation within the cryptocurrency world. How would you plan to make it enough secured for you and of course for the client? And how would you come to your managers with such an offer because of the toughness of the world and the insecurities most of the people are continuously feeling about cryptocurrencies in general?
So I think there are two parts to that answer. First of all, you have to be creative. When you deal with crypto, because it's in many ways uncharted territory, and territory where people are, it's quickly changing, and you have to adapt. We have to be creative, and we have to work. And you'll be surprised to learn how many insurers in the market are actually dynamic enough and creative as well to try and help us find solutions to different situations on that front. So that's one side. The other side is I think it's kind of the opposite to creativity, is they need to see, in order to actually have a business case, to try to create something new, we need to see something that is stable and in a way, in the crypto, that's a bit of a difficult, term, but in a way transparent, because the insurers need to see and to understand what they're insuring. When it's completely out of their control, and when they have no control of the process and the consequence, it's much more difficult for them, obviously, to insure something that is in a certain way in a black box and they cannot understand it. But once you can show them some certain transparency and stability, and I think recent regulations are actually giving that in a way, then insurers are more comfortable saying, okay, I potentially can look at that. Now, look, obviously, that
Yeah,
world.
the regulators move incredibly slow in most of the fields related to cryptocurrencies. So how would you be become extra creative when you come up with a certain solution and trying to offer it to your managers? Even if even to create or to draw a value proposition that would I don't know, fulfill the intention of other of potential clients, I think would be uh might be an illusion. I'm really cautious with every word that I'm putting out because this is a world that's moving fast and slow at the same time, and you cannot really navigate yourself within the ocean of uncertainty. This is why it really catches my interest because building a product that would actually cure a certain need for one of the potential clients is incredibly it's a mission by itself.
It is, but these are things we do. So when you look at our team that deals with, and our international team that deals with crypto, you actually see certain very, very interesting solutions that we actually manage to tailor to clients to cover certain needs. So it could be sometimes more on the physical side, and when you have clients sign the instructions and to make sure nobody's hacking that, to make sure that their transfers are secure. So that's one need. Okay, the other needs could be elsewhere, but you would be surprised again how creative this could be. Again, we have to show always, not even when we go internally at Marsh, but when we go outside to our insurers to actually try and tailor-made a solution for a client, we need to be able to show those insurers transparently what actually they're insuring. That's the key word because once they see that, once they understand what they're insuring, they're understanding the risk, it's much easier. Look, when I started this, I told you. It's much easier to insure in the sense the property and casualty risks. Why? Because they're around for 200 years. You have a loss run of 200 years. You understand how it works. You have the history. You actuarially, it's much easier. It's much more difficult
Absolutely.
to go to crypto when you don't have the loss runs. Eventually the actual calculations are much more difficult. And yet, this is where that world is going. It's going there quite slowly. It's not going there. It's not always catching up the pace where crypto is going, but it's in a very different place than where it used to be. You know what? Not 10 years ago, 5 years ago, completely different. In the set of solutions we can actually offer clients, it's very, very different. And we're anticipating it's going
Of
to go
course.
there even further in the next few years. So
Let me ask you this. If the incredibly slow processes from the regulators and those who really have the heavy due diligence processes on their desks, um, really increase your confidence in the process that you have high intention to ensure.
you mean if as regulation steps forward, then it's easier to insure? That's basically the question.
If regulation baby steps really gets you enough confident with and like creating much more sustainable
In,
water
in, in in certain
population.
aspects, yes, definitely. Because look, this world
Yeah, but
started. Yes,
and if I would ask this exact question, one of your clients, the mess that comes in a much more frequent how to say it in a beautiful manner, the really masses in the cryptocurrency world, what do you think that he would gain more confident in what are you suggesting over time because of the baby steps that everybody actually takes to due diligence the process of
it's a
cryptocurrency
good
regulation?
question. Look, that world started, as you and I both know very well, without any regulation, was handling without any regulation for a very long time. In many ways, it is still completely unregulated. When you look at many aspects of that world, it's still unregulated. So obviously, when it's unregulated, it's much more difficult not only for insurers to work there, but for financial institutions. When you look at large financial institutions and you know the financial markets very well, it's very difficult for them to take that step. It was very difficult and still quite difficult for them taking that step into that world because they're saying, in a way, I don't really understand where I'm going into. They're so used to the regulated environment that it's very difficult for them to go into an environment where there is no paternalistic regulation hovering above it. Now, the baby steps being taken you see them step by step in Europe and as well in the US, giving more confidence because you're seeing the financial institutions coming in, following those baby steps, and starting to allow to play more, to start to participate in that game. For that this time, some of them relatively in in early stages, but they're starting to participate. And the same goes with insurance because insurance comes hand to hand with those players. They're coming in together with them because they cannot handle it without them. So that's where you're seeing them start to come in. I think it's just the tip of the iceberg for now, but you're seeing the need and it's growing every day.
I understand. That question caught my curiosity because I wanted to understand where the majority of the market actually takes apart. Now for unfortunately my last question because we're running off time. I would like to ask you, Peter, this question. Um, right now, the entire world is actually moving towards a really exciting future. Especially we spoke about it in the cybersecurity space and cryptocurrencies and so on, financial markets. And out of your point of view, for the next 3 to 4 years approximately, would would improve your value proposition to the market?
That's a very good question. You left the toughest question to the end. That's I would do probably the same.
But it was Mama Maria over over the episode in the matter of the toughness of the questions.
Look, it's a very fast evolving industry. All those industries, all the industries you and I cover, right? M&A, cyber, crypto at the end, and all the industries in between are very fast evolving industries in a world that is changing quite dramatically as we speak. Like you look at cyber and the way that changed, over the last few years is insane. You
Every
look
change, you need to take a derivative, and
100%.
upon that derivative, you need to operate.
100%. That's what we do. You look at M&A and how that changed, and you look at the waves of M&A in the last few years, and the geopolitical changes and the interest rates and the macroeconomic effects as well. You look at crypto, which we just discussed, which is a completely different world. But I think what we're doing constantly and what we're doing on a day-to-day basis, really, and how we're pushing ourselves is to make sure that we're seeing a few steps ahead. We're seeing where the world is going to be, as you mentioned, in 2, 3 years, and how we can better support our clients. So when you look at M&A, for example, you see today the rise. We just spoke about tax liability insurance, which is something that 5 years ago, 6 years ago, 7 years ago was not really a thing. But we started to see the need growing on that front and the world coming there. Because post-COVID, for example, we saw tax authorities being very aggressive against taxpayers. So the insurance market, and together with us, started to create that solution for taxpayers because we're seeing where the market is going and what we need to achieve for the market. Cyber insurance is a very similar example, and it's constantly evolving. We're updating those policies. We're updating the solutions we're giving our clients. We're updating the way we're handling cyber incidents all the time because it's an ever-evolving game. And crypto, well, for example, we just discussed crypto, and I think this is something where we're trying to catch up. We'll never make it. We'll never catch up with the changes in that industry, but we're trying to catch up with the gap of 5, 10 years where that industry was not really covered well enough. So in that sense, it's super challenging. It's super interesting, but we're always trying to look a few steps forward to see where the market is going, what our clients need, and obviously to be there.
Out of our conversation, I took two things keep uh that I will keep close to my heart. One is how would you build a proper solution to the customers and how you direct your solution in a much better sense to the end need of your customer. And secondly, I would take your point of view over the changes that dramatically passes over all the industries that we just spoke about, which I think as an entrepreneur, really, it is really important and quite unique perspective to embrace. So for first of all, for those for that reason, I would like to thank you for your participation within our show, the Trade Pod. I had an incredible time speaking to you, and it was a pleasure having you here. So we'd like to thank you. And hopefully people would love that conversation because we spreaded um, a good sense in a real perfect manner over the M&A and risk and insurance in the insurance world was for 1 hour incredibly self-explanatory. So thank you for this as well.
Thanks for having me. It was a pleasure. And thanks a lot.
Thank you. All right. Bye, Peter.